Thank you for stopping by my website. If you would like to inquire about a mortgage, click the Start button at the top. Follow the links to the information form and fill out as much as you can. I will follow up with you, let you know how much house you can afford and what items are needed to move forward with your mortgage. This website includes information about different types of mortgages, how to qualify for a mortgage, and frequently asked mortgage questions. If you don't find the answers you need or would like to speak about your unique mortgage situation, please call, text, email, or message me using the links above. I look forward to working with you. A conventional mortgage refers to a mortgage that follows the guidelines set by Fannie Mae and Freddie Mac. It is not guaranteed or insured by the federal government. Conventional mortgages are used for primary residences, your home, second homes, and residential investment properties, 1 to 4 units. For a primary home, conventional loans are available for as little as 3% down payment. Second homes require a minimum 10% down payment, and investment homes require a minimum of 15% down. Any down payment less than 20% will require mortgage insurance. Conventional mortgage loans are subject to maximum loan limits based on the county where the property is located. An FHA mortgage is insured by the Federal Housing Administration. It's the most lenient of all mortgage programs. The minimum down payment for an FHA mortgage is 3.5% for borrowers whose credit score is above 580. FHA does make loans available to borrowers whose scores are below 580 who otherwise qualify for the loan. However, the minimum down payment for these loans is 10%. FHA loans require upfront mortgage insurance based on the loan amount. Upfront mortgage insurance can be financed in with the loan. Additionally, FHA requires monthly mortgage insurance, which is included with the loan payment. FHA sets a maximum loan limit for this program. FHA mortgages are only available to finance a borrower's primary residence. VA loans are guaranteed by the Department of Veterans Affairs. These loans are available to active military, qualifying military veterans, and the qualifying surviving spouse of a military veteran. VA loans provide 100% financing. There's an upfront funding fee for VA loans, but this can be financed into the loan amount. VA mortgages are the most generous of all mortgage programs. VA mortgages are only available to finance a borrower's primary residence. USDA loans are guaranteed through the United States Department of Agriculture as part of their Rural Development Program. This program provides 100% financing for properties located in the USDA eligible area. Borrowers are subject to household income limits, and the debt-to-income ratio tolerance is lower than that of other government loans. The upfront guarantee fee can be financed into the loan. Additionally, USDA loans require monthly mortgage insurance, which is included in the loan payment. USDA mortgages are only available to finance a borrower's primary home. Any mortgage loan for an amount above the conventional conforming loan limit is considered a jumbo loan. Interest rates and closing costs tend to run higher on jumbo loans than on conventional loans. Additionally, most lenders require an above-average credit score to qualify for jumbo borrowers. Any mortgage that does not fall into the conventional or government category is considered a non-traditional mortgage. These include bank statement programs, stated income programs, foreign national lending, loans to borrowers with recent bankruptcies or foreclosures, hard money loans, etc. These loans are offered by private investors. The interest rates, closing costs, and down payments for these loans are higher than for traditional mortgage programs. However, non-traditional lending can be a great vehicle to get otherwise unqualified borrowers into a home of their own. If you feel a non-traditional mortgage might be right for you, make sure you have a clear understanding of the pros and cons of this type of loan. A reverse mortgage, or HECM loan, is available to borrowers age 62 and older. A reverse mortgage turns the homeowner's equity into tax-free monthly income or lump sum cash. The homeowner is not required to make a monthly mortgage payment as long as they live in the home. The homeowner is required to maintain the home and is responsible for paying property taxes and hazard insurance on the home. Reverse mortgages are insured by the Federal Housing Administration. A reverse mortgage can also be used to purchase a home. A qualifying senior can purchase their next primary home with a reverse mortgage and never have to make a mortgage payment as long as they live in the home. The homeowner is required to maintain the home and is responsible for paying property taxes and hazard insurance on the home. What is a mortgage? A mortgage is a legal agreement that outlines the terms between a borrower and a lender for the purpose of buying or refinancing real property. How do I qualify for a mortgage? Lenders look at three things when qualifying a borrower for a mortgage: income, assets, and credit. For income, a borrower needs to show at least 2 years of work history. Recent college graduates who are currently employed can count their time in school toward the required 2 years. If a borrower receives commission, bonus income, overtime wages, or is part-time, the borrower must show a 2-year history of receiving these types of income. Self-employed borrowers need 2 years of employment in the same business. The amount of usable self-employment income is determined by review of federal tax returns. Assets. Borrowers need to show enough funds available to cover the down payment and all closing costs associated with the mortgage. Additionally, some lenders require borrowers to show enough extra funds to cover multiple months of mortgage payments. All funds need to be seasoned in a U.S. bank account for at least 2 months. Cash does not count. Credit. To qualify for a mortgage, your lender will need to pull your tri-merge credit report. Your qualifying credit score will be the middle of the 3 scores. Conventional loans require a minimum score of 620. FHA and VA allow for lower credit scores. Your credit report also shows your monthly payment obligations for credit cards, auto loans, and student loans, etc. What if I've had a bankruptcy, foreclosure, or just bad credit? FHA and VA will allow financing as soon as 2 years from the discharge date of a Chapter 7 bankruptcy. Foreclosures have a 3-year waiting period with FHA and a 2-year waiting period with VA. A borrower must have reestablished credit and otherwise qualify for the mortgage. FHA will tolerate credit scores as low as 500 for borrowers who otherwise qualify. Keep in mind, a credit score between 500 and 579 requires a 10% down payment on FHA loans. VA does not set a minimum score for borrowers. However, most lenders set a minimum qualifying score. What options are there for no down payment or a low down payment? USDA and VA loans require no down payment. FHA offers a no down payment loan for qualifying borrowers whose primary home was destroyed in a federally declared disaster area within the last 12 months. FHA offers a $100 down payment for qualifying borrowers who purchase a HUD-owned property. Conventional loans offer 3% down payment, and FHA offers 3.5% down payment to qualifying borrowers. How long will it take to close on the mortgage? Most traditional loans take about 30 days from the time your loan goes into underwriting until you're at the closing table and taking possession of your new home. Foreign national loans usually take 45 to 60 days. Reverse mortgages take about 60 days. As a general rule, straightforward files can close sooner, while more complicated files can take longer. What are closing costs? Closing costs are all the costs associated with securing the mortgage. They can include credit report fees, title insurance, appraisal, survey, HOA fees, underwriting fee, origination fee, processing fee, upfront mortgage insurance, VA funding fee, etc. They can also include prepaid fees, such as your first year of insurance, and deposits to set up your property tax and hazard insurance escrow accounts. All possible closing costs should be disclosed to you within 3 days of applying for a mortgage. Closing costs average 3 to 6% of the purchase price of the home. What will my interest rate be? It depends. Interest rates fluctuate several times a day. The base rate will be adjusted on your unique qualifying factors. Good credit scores or a large down payment can lower your base rate. Poor credit scores or a minimal down payment can raise your base rate. What is a fixed rate versus an adjustable rate? A fixed interest rate will not change for the life of your loan. An adjustable rate can change over the life of your loan. However, the lender cannot arbitrarily change your interest rate. Any rate adjustment will be tied to a market index, such as a U.S. Treasury note or LIBOR. Adjustment periods should be disclosed to you by your lender before you sign your mortgage agreement. All terms will be outlined in your mortgage. If I have a fixed-rate mortgage, why did my payment change? Amortized fixed-rate mortgages provide for a fixed principal and interest payment throughout the life of the loan. However, most mortgage payments also include payments toward your real estate taxes and hazard insurance payments. While the principal and interest payment remains fixed from year to year, the tax and insurance payments typically adjust annually. What is mortgage insurance, MIP and PMI? Mortgage insurance, or MI, is insurance that protects the lender from loss if a mortgage goes into default. It is paid by the borrower to protect the lender. Mortgage insurance premium, or MIP, is charged on FHA loans. There's a one-time upfront component that can be financed into the loan. There's also a monthly portion that's added to the monthly mortgage payment. Private mortgage insurance, or PMI, is charged on conventional loans where the down payment is less than 20%. What is title insurance? Title insurance protects the borrower and the lender from any claims to title once the loan is closed. It is a one-time charge paid at the loan closing. What is DTI? DTI stands for debt-to-income ratio. A front-end DTI shows the borrower's total housing payment as it relates to the borrower's income. A back-end DTI considers the total housing payment plus all other borrower debt, such as car payments, student loans, credit cards, etc. What is LTV? LTV stands for loan to value. It is the percentage of the mortgage compared to the appraised value of the property. For example, a borrower with a down payment of 10% on a $100,000 purchase would have an LTV of 90%. What is escrow? An escrow account is like a forced savings account. Most lenders require borrowers to have an escrow account for their property taxes and hazard insurance payments. These accounts are set up by the lender and are managed by your loan servicer. Your monthly mortgage payment will include your principal and interest payment, P&I, plus 1/12 of your annual property taxes and 1/12 of your annual hazard insurance fee. For example, if your annual property taxes are $2,400 and your annual hazard insurance policy is $1,200, your monthly mortgage payment will include your escrowed tax payment of $200 and your escrow insurance payment of $100. When the property taxes are due and when the insurance policy renews, the lender will pay these bills on your behalf out of these escrowed funds. What is an appraisal? An appraisal is an opinion of value provided by a licensed real estate appraiser. The appraiser will take into consideration the condition of the subject home compared to nearby properties and recent sales prices. What is a survey? A property survey is a map showing property boundaries, easements, and physical features of an area of land. It designates where buildings and other permanent improvements are situated on the property. About me. I'm a licensed mortgage loan originator in the state of Florida, NMLS number 1037533. I'm also a certified veterans loan specialist. I have a Bachelor of Science degree in finance from the University of Central Florida. I'm here to help borrowers purchase a home. If a borrower does not qualify, we will work together to create a personalized plan to qualify in the future. If I can help you with your mortgage needs, please contact me today.